Most people think the biggest bank failure in history was Lehman Brothers. But that isn't the full story. Lehman was massive. It shook Wall Street, froze markets, and became the symbol of the 2008 financial crisis. But some banks on this list were even larger. Some were so deeply connected to their countries that governments feared one collapse could pull an entire economy into the dark. Imagine waking up and seeing your bank's name on every news channel. The share price is collapsing. Customers are trying to withdraw money. Politicians are meeting behind closed doors. And somewhere, a decision is being made. Will this bank open tomorrow or disappear tonight? This isn't just a story about bad loans. It is a story about confidence, the invisible force that keeps banks alive. Because when confidence dies, even the biggest bank in the world can fall. In this documentary, we count down the 20 biggest bank failures and emergency rescues in modern history, not just in the United States, but across the world. Some collapsed in bankruptcy, some were nationalized, some were sold overnight, some were broken apart by governments, and some were so dangerous that leaders had only one choice: rescue them or risk something even worse. And number one is much bigger than most people realize. Over $3.5 trillion in assets. 2008, United Kingdom. Royal Bank of Scotland. Royal Bank of Scotland wasn't just another bank. At one point, it was one of the largest financial institutions in the world. Its balance sheet was so huge that it was bigger than the economy of many countries. But size didn't save it. In 2007, RBS joined the takeover of ABN AMRO, one of the most expensive banking deals ever attempted. The timing couldn't have been worse. The global credit system was already beginning to crack. Then Lehman Brothers collapsed. Funding markets froze. Banks stopped trusting each other. Investors panicked. And suddenly, Royal Bank of Scotland wasn't just in trouble, it was close to disaster. The British government had to step in with a massive rescue. Taxpayers injected billions, and the state became the dominant owner of the bank. This wasn't a small failure. This was a giant that became too dangerous to let fall. Royal Bank of Scotland proves one thing immediately. A bank can look powerful, historic, and untouchable, and still be only days away from collapse. But Britain's banking disaster didn't stop there. 690 billion British pounds in assets. 2008, United Kingdom. Halifax Bank of Scotland. HBAL looked like a familiar name on the British High Street. It was created from Halifax and Bank of Scotland, and for years it rode the United Kingdom's property boom higher and higher. From the outside, it looked strong, but inside the bank, risks were building. HBOS had grown aggressively. It expanded in corporate lending, commercial real estate, and international markets. Growth looked like success until the economy turned. When the financial crisis hit, the bank's weaknesses were exposed. Funding became harder, losses became more serious, confidence disappeared. HBOS couldn't survive alone. A rescue takeover by Lloyds was arranged, but the damage was so severe that the combined Lloyds group later needed taxpayer support too. HBOS is a warning about growth, because fast growth can look impressive on paper. It can make executives look brilliant. It can make investors excited. But if that growth is built on dangerous lending, it can become a trap. HBOS didn't explode in one dramatic moment. It failed because risk had been allowed to build quietly for years, and when the crisis arrived, there was no time left. 775 billion euros in assets. 2008, Belgium, Netherlands, and Luxembourg. Fortis Group. Fortis was a cross-border financial giant. It operated across Belgium, the Netherlands, and Luxembourg, and it was deeply connected to European finance. But Fortis made one of the same mistakes that helped destroy Royal Bank of Scotland. It joined the takeover of ABN AMRO. The deal was huge. The timing was terrible. As the global financial crisis deepened, Fortis became weaker and weaker. Investors lost confidence. Depositors became nervous. The share price fell. Then governments had to move. Belgium, the Netherlands, and Luxembourg all became involved. Emergency capital was announced. The Dutch state took over Fortis's Dutch operations. The Belgian side was eventually moved toward BNP Paribas. Fortis didn't simply collapse in one clean event. It was dismantled. That is what makes international bank failures so complicated. They don't always break inside one country. They break across borders, across governments, across legal systems, and across millions of customers. Fortis showed Europe how dangerous a cross-border banking crisis could become. And it wasn't the only one. 651 billion euros in assets. 2008 to 2011, Belgium, France, and Luxembourg. Dexia Bank. Dexia wasn't as famous as Lehman Brothers, but inside European finance, it mattered enormously. Dexia was deeply involved in lending to local governments and municipalities. That might sound safe. It might even sound boring. But behind that business was a huge and fragile balance sheet. When the 2008 crisis hit, Dexia needed rescue. But the first rescue wasn't the end. As Europe moved from the global financial crisis into the sovereign debt crisis, Dexia came under pressure again. Governments had to step in repeatedly, and the bank was eventually placed into a long wind-down. Dexia is a different kind of bank failure. It wasn't one dramatic explosion. It was a slow-motion collapse. A bank can fail loudly, like Lehman, or it can fail slowly, shrinking year after year, supported by governments, while old risks are gradually unwound. Dexia teaches a powerful lesson. A bank doesn't need to be famous to be dangerous. Sometimes the most important banks are the ones ordinary people have barely heard of. $639 billion in assets. 2008, United States. Lehman Brothers. Lehman Brothers is the name everyone remembers. On September 15, 2008, Lehman filed for bankruptcy. It became the largest bankruptcy in American history at the time, and its collapse sent shockwaves through the entire world. But Lehman was more than one failed investment bank. It was a signal. When Lehman fell, the world realized that even a major Wall Street institution might not be rescued. That changed everything. Banks became afraid to lend to each other. Investors rushed for safety. Money markets trembled. Credit markets froze. The financial crisis became global panic. For employees, the collapse was personal. People walked out carrying boxes from a company that had survived wars, depressions, and more than a century of financial history. For the world, it was terrifying. Lehman proved that confidence could disappear over a single weekend, and once confidence was gone, even the most powerful institutions could fall. Lehman may not be the largest bank failure on this list by assets, but emotionally, psychologically, and historically, it became the symbol of the crisis. 530 billion Swiss francs in assets. 2023, Switzerland. Credit Suisse. Credit Suisse didn't collapse like Lehman. It wasn't allowed to. For generations, Credit Suisse was one of the great names in global banking. It was part of Switzerland's identity as a center of wealth, secrecy, stability, and financial power. But years of scandals, losses, management problems, and client withdrawals weakened the bank. By March 2023, confidence was disappearing fast. And in banking, disappearing confidence is deadly. Swiss authorities moved quickly. UBS, Credit Suisse's biggest domestic rival, agreed to take it over in an emergency deal. The goal was to prevent a disorderly failure that could spread through global markets. But the message was still shocking. A legendary Swiss banking name was gone. Some investors were wiped out. Shareholders were forced into a deal. The bank that had stood at the center of Swiss finance for more than a century was absorbed by its rival. Credit Suisse shows that modern banks can die without closing every branch. The doors may stay open. The customers may still access their accounts, but the institution itself can disappear almost overnight. 400 billion euros in assets. From 2008 to 2009, Germany. Hypo Real Estate Holding AG. Hypo Real Estate was a German financial giant focused on property, public sector lending, and infrastructure finance. It looked specialized, but it had a dangerous weakness. It depended heavily on short-term funding. When markets were calm, that worked. But when the crisis hit, short-term funding became a lifeline that could be cut at any moment. Inside the group, its Irish subsidiary Deptha became a major source of trouble. The bank struggled to roll over funding. Suddenly, Germany faced the possibility that a major institution with hundreds of billions in assets could fail. The German government stepped in. Rescue packages were arranged. Eventually, Hypo Real Estate was nationalized. This failure is important because it shows that banks don't collapse only because loans go bad. They can also collapse because they cannot fund themselves. A bank can own long-term assets, but if it depends on short-term borrowing to survive, it is vulnerable. The moment lenders refuse to roll over that funding, the clock starts ticking. Hypo Real Estate ran out of time. $400 billion in assets. 2008, United States. Bear Stearns. Before Lehman Brothers, there was Bear Stearns. Bear Stearns was one of America's major investment banks. It had survived for decades and played a major role on Wall Street. But in March 2008, confidence in the firm collapsed. Bear depended heavily on short-term funding. When lenders and trading partners became nervous, the bank's liquidity position deteriorated quickly. Suddenly, Bear Stearns was facing the possibility that it couldn't meet its obligations. The Federal Reserve helped arrange emergency support, and JP Chase agreed to buy the bank in a rescue deal. It happened over a desperate weekend. This was the warning. Bear Stearns showed that the financial system was far weaker than many people wanted to believe. But because Bear was rescued, many investors assumed the government would rescue the next major Wall Street firm too. 6 months later, Lehman Brothers failed. Bear Stearns was the warning flare. Lehman was the explosion. 340 billion euros in assets. 2012, Spain. Bankia S.A. Bankia was born from Spain's property bubble. It was created by merging 7 savings banks, known as cajas. On paper, the merger looked like a solution. In reality, it concentrated huge problems inside one massive institution. Spain had experienced a real estate boom. Credit expanded. Developers borrowed heavily. Property prices rose. Then the boom ended. Bankia went public in 2011, but soon the losses became impossible to ignore. By 2012, the bank had to be nationalized. Its crisis helped push Spain toward a European-backed banking rescue. Bankia shows one of the great dangers of financial crises. Combining weak institutions doesn't automatically create a strong one. Sometimes it simply creates a bigger weak institution. The collapse wasn't just about bad loans. It was about real estate mania, political influence, poor supervision, and the belief that property prices would keep rising forever. They didn't. And when property prices turned, Bankia became one of Europe's biggest banking disasters. $307 billion in assets. 2008, United States. Washington Mutual. Washington Mutual, often called WAMU, was the largest bank failure in FDIC history. This wasn't an investment bank like Lehman Brothers. This was a retail bank. It had branches, depositors, mortgages, ordinary customers. WAMU had grown aggressively during the American housing boom. It became deeply involved in risky mortgage lending. When housing prices weakened and defaults rose, the bank came under pressure. Then confidence broke. Depositors began pulling money out. Regulators stepped in. On September 25, 2008, Washington Mutual was closed, and JP Chase acquired most of its assets and deposits. For customers, the goal was to keep the banking system functioning. For shareholders, the result was devastating. WAMU is important because it shows that the 2008 crisis wasn't only a Wall Street story. It reached into ordinary banking, it reached into mortgages. It reached into neighborhoods, suburbs, and families. Lehman was the dramatic symbol, but Washington Mutual showed how deeply the housing crisis had damaged America's banking system. $240 billion in assets. 1998, Japan. Long-Term Credit Bank of Japan. Before the global financial crisis of 2008, Japan had already lived through a banking nightmare of its own. In the 1980s, Japan's asset bubble seemed unstoppable. Stock prices soared, land values exploded, banks lent aggressively into the boom. Then the bubble burst. The Long-Term Credit Bank of Japan became one of the most important casualties of the crisis. This wasn't a small lender. It was a major institution tied to Japan's post-war corporate finance system. But bad loans and deep financial weakness pushed it into crisis. In 1998, the Japanese government temporarily nationalized the bank. The collapse was part of Japan's long struggle with bad debts, weak banks, and the painful aftermath of a massive asset bubble. The lesson is powerful. When an economy pretends bad loans are still good, the problem doesn't disappear. Japan's banking crisis showed the world that the aftermath of a bubble can last for years, sometimes even decades. 113.5 billion British pounds in assets. 2007 to 2008, United Kingdom. Northern Rock. Northern Rock created one of the most shocking images of the British financial crisis. People standing in lines outside bank branches, trying to withdraw their savings. It looked like something from another era. But this was 2007. Northern Rock had grown rapidly by relying heavily on wholesale funding instead of traditional deposits. That worked as long as markets stayed calm. But when funding markets tightened, Northern Rock suddenly faced a serious liquidity crisis. The Bank of England provided emergency support. The public saw the headlines. Depositors panicked. The queues became a symbol of fear. In February 2008, Northern Rock was nationalized. This failure is powerful because it turned a complicated financial problem into something everyone could understand. You didn't need to understand securitization. You didn't need to understand wholesale funding. You only needed to see people lining up outside a bank. Northern Rock showed that bank runs weren't just history. They could still happen, and years later, they would happen even faster. Digitally. $229 billion in assets. 2023, United States. First Republic Bank. First Republic was built around wealthy clients, jumbo mortgages, and high-touch banking service. For years, that model worked. But in 2023, after the failures of Silicon Valley Bank and Signature Bank, fear spread across regional banks in the United States. First Republic had a large base of uninsured deposits. That made it vulnerable. Depositors didn't need to stand outside branches. They could move money with a few taps on a phone. Other major banks tried to support First Republic by placing deposits into it. But the pressure continued. On May 1, 2023, regulators closed the bank, and JP Morgan Chase acquired most of its assets and deposits. First Republic became one of the largest bank failures in American history. Its collapse showed how modern banking panic moves, not through lines around the block, not through crowds outside locked doors, but through phones, apps, wire transfers, and instant fear. In the digital age, a bank run can happen at terrifying speed. $209 billion in assets. 2023, United States. Silicon Valley Bank. Silicon Valley Bank was the bank of startups, venture capital, and the technology world. For years, that focus looked like a strength. Tech companies raised huge amounts of money and deposited it at SVB. The bank invested much of that money in securities. But then interest rates rose. As rates climbed, the value of those securities fell. At the same time, startup funding slowed, and clients began using their deposits. Then the bank announced it needed to raise capital. That announcement triggered fear. Venture capital firms warned portfolio companies. Depositors rushed to move money. Social media and private group chats spread concern at lightning speed. On March 10, 2023, Silicon Valley Bank was closed by regulators. It became one of the largest bank failures in American history. SVB showed the world a new formula for bank panic: concentrated customers, uninsured deposits, rising interest rates, and digital withdrawals. The old bank run had people waiting outside. The new bank run happens through a screen. 147 billion euros in assets. 2017, Spain. Banco Popular Español. Banco Popular is one of the most traumatic European bank resolutions because of one unbelievable detail. It was sold for €1. In June 2017, European authorities determined that Banco Popular was failing or likely to fail. The bank had suffered for real estate exposure, weak confidence, and mounting pressure. There was no time for a slow rescue. Overnight, authorities resolved the bank and transferred it to Santander. Santander paid €1. Depositors were protected. Branches continued operating. The banking system avoided a chaotic collapse. But shareholders and certain investors were wiped out. Banco Popular matters because it showed Europe's post-crisis resolution system in action. Instead of using taxpayer money, authorities forced losses onto investors and transferred the bank quickly. From the outside, many customers may have seen business continue. But behind the scenes, an entire bank had effectively died overnight. Sometimes a bank failure doesn't look like locked doors. Sometimes it looks like a new owner and a price tag of €1. 101 billion euros in assets. 2009, Ireland. Anglo-Irish Bank. Anglo-Irish Bank became one of the most infamous names in Ireland's financial crisis. During the boom, it was deeply exposed to property developers and real estate lending. When Ireland's property market was rising, Anglo-Irish looked successful. When the market crashed, that same exposure became catastrophic. The Irish government nationalized Anglo-Irish in January 2009. But the pain didn't end there. The cost of supporting Ireland's broken banking system became enormous, and Anglo-Irish became a symbol of reckless lending, political anger, and taxpayer burden. For many people in Ireland, the question was simple and painful. Why should ordinary citizens pay for the mistakes of bankers? Anglo-Irish was later merged into a resolution structure and wound down. This failure shows how a bank collapse can become a national trauma. It wasn't only about balance sheets. It was about trust, anger, austerity, and accountability. A bank failed, but an entire country felt the consequences. $110 billion in assets. 2023 United States. Signature Bank. Signature Bank failed during the same wave of fear that followed Silicon Valley Bank. It was based in New York and served large commercial clients. It also had a significant amount of uninsured deposits. That made it vulnerable when fear spread across regional banks. After Silicon Valley Bank collapsed, depositors and markets began asking a dangerous question: which bank is next? Signature came under pressure quickly. On March 12, 2023, New York regulators closed the bank, and the FDIC was appointed receiver. This failure is important because it shows how contagion works. Banking panic often spreads by comparison. Depositors may not know every detail of their bank's balance sheet, but they see another bank fail, and they begin to wonder if their own money is safe. That fear can become self-reinforcing. Signature Bank wasn't the same as Silicon Valley Bank, but in a panic, differences can disappear. Fear looks for the next target, and once it finds one, time runs out fast. 82 billion euros in assets. 2013, Netherlands. SNS Real. SNS Real was a Dutch banking and insurance group. Its fatal weakness was real estate. After the global financial crisis, losses in its property finance division became too large to ignore. The Dutch government looked for private solutions, but no acceptable rescue was found. Then the state moved. In February 2013, the Netherlands nationalized SNS Real. The government said the action was necessary to protect financial stability and prevent wider economic damage. Shareholders and subordinated creditors were expropriated. The state committed billions in capital, loans, and guarantees. SNS Real reminds us that the 2008 crisis didn't really end in 2008. Its aftershocks continued for years, especially in countries and institutions exposed to real estate. Property booms can create the illusion of safety. Buildings look solid, loans look secured. But when real estate values fall, the damage can last far longer than anyone expects. SNS Real was one more victim of that delayed collapse. 80 billion euros in assets. 2014, Portugal. Banco Espírito Santo. Banco Espírito Santo carried one of Portugal's most famous financial names. It wasn't just a bank. It was part of a powerful business empire with deep historical roots. But prestige isn't protection. In 2014, problems connected to the wider Espírito Santo group pushed the bank into crisis. Losses mounted. Confidence collapsed. Regulators had to act. Portugal's central bank resolved Banco Espírito Santo and created a new bridge bank called Novo Banco. The healthier parts of the institution were moved into the new bank. Problem assets and liabilities remained behind in the old structure. This is the classic good bank, bad bank idea. Separate what must continue from what must be wound down. For customers, the system needed stability. For investors, the damage was severe. Banco Espírito Santo shows how hidden problems inside a wider corporate group can threaten a major bank. A famous name can survive for generations. Then, when trust breaks, it can fall with shocking speed. 58 billion euros in assets. 2008, Iceland. Kaupthing Bank. Kaupthing closes our list because its story is bigger than one bank. Before 2008, Iceland's banks expanded at breathtaking speed. Kaupthing, Landsbanki, and Glitnir grew far beyond the size of Iceland's own economy. They borrowed internationally. They expanded abroad. They built balance sheets that were enormous compared with the countries standing behind them. Then the global credit system froze. Suddenly, Iceland's banks couldn't fund themselves. The system collapsed. Kaupthing was taken over, and Iceland entered one of the most dramatic national banking crises in modern history. This is the terrifying lesson of Iceland. When banks grow too large for the country behind them, the country itself becomes exposed. A government can rescue a bank when the bank is smaller than the state. But what happens when the banks become larger than the nation? Iceland had to face that question in real time. Kaupthing's collapse showed the world that banking crises are not only about institutions. Sometimes they threaten the identity, currency, economy, and future of an entire country. So, what do the biggest bank failures in history have in common? Not one simple thing. Some were destroyed by property bubbles, some were destroyed by short-term funding, some were destroyed by bad acquisitions. Some were destroyed by hidden losses, some were destroyed by panic, some went bankrupt, some were nationalized, some were sold overnight, some were broken apart by governments, and some survived in name only. But underneath every story is the same fragile foundation: trust. A bank can have marble floors, global offices, famous executives, and hundreds of billions in assets. But if depositors, investors, lenders, and governments stop believing it can survive, the end can come incredibly fast. That is why banking crises feel different from ordinary business failures. When a normal company fails, customers lose a supplier. When a major bank fails, people wonder if their money is safe. They wonder if their job is safe. And that fear can move faster than facts. The biggest bank failures are not just financial events. They are moments when society discovers how much of modern life depends on confidence. Banks don't collapse only when they run out of money. They collapse when they run out of trust. Thank you for watching. And remember, the next financial crisis may not look like the last one.